School. For more on how today's CPI might impact the road ahead for rate cuts, let's welcome in the Wall Street Journal's Nick Timiraos. It's good to have you. I don't know if you had a chance to listen to the conversation and the debate that the professor and Ed were having over what the Fed should do. I think we know what it will do, but what do you make of this idea that they may be walking into a problem if they cut into a situation where maybe they don't have to?
Well, I think, Scott, what you had in the CPI this morning is that whatever suspense there was around not just next week's Fed meeting, but the one in December, it went down after this report, right? The argument for the hawks weakened a little bit here. Part of the problem simply is just we're not going to have that much data perhaps before the December meeting. But rate cuts were the path of least resistance before this report, and you lost some of that resistance after the report. I think that, on tariffs, you do see some pass through. Everybody's saying, well, there's been no pass through. You are seeing some pass through. It's just relative to what people were worrying about in the spring and early summer. It's a lot less. So maybe this was a classic, sales tactic by the president. Make people sick, make them think you're going to see 4% inflation, and then they feel a lot better when it's only at 3%. It was at 2.4% in September last year, Scott. So it really kind of depends on compared to what here when you're looking at, was this a good inflation report?
Do you think that Chair Powell is worried about initiating a bubble in the stock market by continuing to cut at levels we're already at record highs? How do you think that he thinks about that?
This has come up time and time again, and it doesn't seem like it's ever been a huge worry. Look at the housing finance market right now. Look at financial conditions for housing. It's hard to argue that they are quote unquote easy. So, there are of course different segments of the economy. Stock market's doing well, AI related growth doing great, but there are still parts of the economy you see, delinquencies rising on subprime auto, delinquencies rising on FHA loans. So I think you kind of have to take all of it, and you can't just pick apart one sector versus the other.
Is there any chance that they would go 50 basis points, and what would cause them to do that? Would they have to see data that would force their hand rather than do it preemptively?
Yeah, 50 basis points on the basis of an inflation reading where you're still at 3%, that doesn't make a lot of sense. I think to the extent that the inflation numbers aren't as bad as you worried they could be, it maybe removes some resistance if you were to see really ugly labor market deterioration, which of course we're not seeing while we're in the shutdown. When the data comes back on, you'd have to just see really ugly labor market data. And on top of that, the October payroll number is going to be already sort of mushy because of both the fork in the road, deferred DOGE buyouts from earlier in the year, and then the government shutdown, which could create some idiosyncrasies for these government workers who were furloughed in October. But, 50 basis points is just not where the conversation is right now. You'd have to see a lot worse data on the labor market, Scott.